So you have decided to invest in the stock market, or you have taken baby steps, or you are already halfway through your journey of investing. Now let me ask you a quick question. How do you select your stocks? Maybe you look at what the company is doing, analyze the financial metrics, read the annual reports, estimate how well the company will do in future, and then select the stocks accordingly. Wow, you are taking an educated guess. But wait, how many of us have the knowledge and know how to pick a stock in an intelligent manner like this? Give me your frank opinion. We should all accept the bitter truth. Not many of us are intelligent to make such decisions. We rely on bits and pieces of information from news channels, newspaper or magazine articles, or better yet, listen to famous YouTubers recommending the hot stocks for this week, should you participate in this IPO, etc. We try to put these pieces of information together into the puzzle and try to make a decision. We look up to them as godfathers, right? Oftentimes than not, we fail. The stock for which we have high expectations dips suddenly. We look back at the recommendations of the so-called experts and laugh at them, rather laugh at ourselves. Well, this is the undeniable reality of the stock market. The market as a whole is intelligent than any of us. No single person is here to outsmart the rest of us all. Now, what if I tell you that you don't have to spend hours and hours of your valuable time picking stocks? Instead, you could throw your savings amount into a fund and forget about it for few years, never to track it every day and break your head over whether the market is falling or rising, and to get a modest and consistent returns over long term. Don't believe me? Let me explain. When I said you could just throw your money into a fund, that fund is nothing but a list of stocks. What kind of stocks? Exactly the same as the stocks in the index. What's an index? If you want to have a detailed explanation of index, refer to my video here. Anyway, index is just a measure of some very important stocks. Those very important stocks which are the pulse of our Indian economy. So this index, which has some very important stocks, is what our fund tries to copy. For example, we have an index called Nifty, which measures the performance of top 50 companies of India. Our fund will invest our money into the same 50 companies if our fund is a Nifty fund. We have another index called Sensex, which measures the performance of top 30 companies of India. Our fund will invest our money into the same 30 companies if our fund is a Sensex fund. In essence, our fund is just a carbon copy of the index, and hence our fund is called the index fund. If you understood this point that an index fund has the same portfolio of stocks as in an index, then congratulations, you got the point right. Welcome to the world of indexing, and you are here with me in my channel Money for Life Simplified, where I give you great concepts in just simple, sweet and small bundles. Now that you know an index fund is a basket of stocks that you invest in, the same set of stocks as in an index. Let's talk a bit further. What comes to your mind when you look at the word fund? Yes, you got it right. It can also be a mutual fund, meaning you can buy a mutual fund which has the same stocks as those in the index, that is, an index mutual fund. Say for example, you if you want to invest in the same 50 stocks as in the index Nifty, you can buy a few units of UTI Nifty Index Fund. Where do you buy it? You can buy it through your brokerage account like Zerodha, or you can visit UTI's website and buy some units. Alternatively, you can invest in the same set of stocks as an index by buying an ETF, that is, an exchange traded fund. Say for example, you can buy few units of an ETF called Nippon Nifty Bees, which again invests your money in the index Nifty. Now, where do you buy these units of ETF? On the stock exchange, just like you buy shares. Not through the company's website, but just traded on the stock exchanges. When do you receive these units in your portfolio? Any order you place to buy or sell these units will be executed on the end of the very same day or on the next day. Only then you receive those units into your portfolio. On the other hand, if you buy few units of ETF, it's like buying few units of shares, which means you can buy and sell them anytime on the exchange, and the orders are executed immediately during the market hours, just like shares, provided there are buyers and sellers on the other side, of course. Let's see how much of our investment money is taken as charges for managing our funds. If we compare index funds with other non-index based actively managed mutual funds, index funds are way inexpensive, charging only 0.2% compared to about 1 to 2% for an active fund. The reason we are charged very less for an index fund is that the index fund manager has a very passive style of investing, meaning he just allocates our money to those stocks which are in the index. He doesn't have to really worry whether the stocks are performing well or not. In fact, if the stocks are not performing well, they wouldn't be a part of the index at all in the first place. On the other hand, the fund manager of an active fund takes the pain of selecting the stocks for you and shuffling them as needed. Whether or not he gives us success is another thing to discuss. This minor difference of charges may seem very less in the short term, but in the long term they add up to what is called as tyranny of compounding, squeezing out your returns unfavorably. There is no real risk of human error with an index fund manager, at least in terms of stock selection. The investments in the fund are not chosen by one person, but rather based on a selection of well-performing investments. An active fund manager's job is to beat the market, which means he must often take on conscious market risk in order to obtain good returns. Even an active fund manager who is able to avoid human emotion and error can't get past the unpredictable nature of the stock market. This is a risk to our portfolio. Let's talk about taxes and other costs. Since the portfolio of an index fund is the same as index and the stocks in the index don't change very often, managing the index fund is very easy. There is no need to buy and sell the stocks often, and hence no frequent capital gains taxes and no transaction costs are incurred. Because the fund manager has to reshuffle our portfolio in an effort to generate more returns, more capital gains taxes and transaction costs are incurred, which are eventually passed on to us as investors. How many actively managed mutual funds survive over long term? As per the latest SPIVA report of 2020, only 70% of the large, small and mid-cap funds actually survived. So if you think of long-term investing, beware. Your active mutual fund may not exist at all and you lose the benefits of compounding. The final point of comparison is the returns. Index funds give you moderate and, more importantly, consistent long-term returns. The returns of active mutual funds are unpredictable. May be great for short term, that too if luck favors. But in the long term, index funds have time and again put active managers to shame. Well, that's at least what the latest SPIVA report says. More than 80% of the active mutual funds fail to beat the index over a time frame of 5 years and 10 years. Whether you are a beginner investor or an experienced, index funds beautify your portfolio in a safe and sound manner. I leave you here with few opinions of the legends like Warren Buffett and Jack Bogle.
I recommend the S&P 500 index fund and have for a long, long time to people. And I've never recommended Berkshire to anybody because I don't want people to buy it because they think I'm tipping them into some side. Never. I mean, no matter what it was selling for. And I've made it public. On my death, there's a fund for my then widow, and 90% will go into an S&P 500 index fund, and 10%.
A quote I don't even remember where I made, but it said, "I don't know anybody who has ever been successful in timing the market. I don't even know anybody who knows anybody who has ever been successful in timing the market." Last year, these last 2 years, the index, S&P index, has outperformed roughly half of the funds, a little bit less last year, just about half this year. I don't regard that as a significant long-term sign at all. First of all, the number of funds is not a relevant statistic. We use it because it's convenient, but if you've got a few little funds in there that do well, they count just as much as a few big funds. The reality is, no matter what the statistics tell you, indexing always wins. I say that because index is delivering the market return, and all those investors out there are by definition getting the market return themselves, less cost.